Hi, today's topic is two worlds continued and why they will never meet. There are two very different worlds or approaches to valuing business today. One, the valuation world versus two, the accounting world. One gets its information from markets and the other manipulates its information from financial statements. The valuation world operates by discerning market activity in search of reliable, provable numbers, whereas the accounting world records prices paid by current management without reconciling to market values. No two people will run a business the same way, nor will they pay the same price for any goods or services, which has massive legal implications following each transaction. But first, let me show you why. Business A may buy a desk for $500. Business B buys it for $300. Assume the desk has a market value of $400. Business A paid a premium. Business B got a discount. So the accounts of both businesses do not represent market values. The purchase of tangible assets follows the same path. Business A may buy a truck for $40,000, whereas business B may pay $50,000. And let's assume the market value is $45,000. Or a more sinister transaction takes place, such as paying $60,000 to a family member who purchased the truck for $40,000. Then business A buys stock and pays cash and gets a price 10% below wholesale price, whereas business B pays 10% over wholesale, maybe because he has poor credit rating. All accounting does is record the prices paid by current management, which may be good or bad. My advice to valuers is never trust financial statements. They are a guide only. Always seek provable numbers on which to base any valuation and never trust accrual accounting. And the only provable number you can rely on is sales. And you can prove sales by checking the bank statements. It is the only number you can use to compare the subject business to other sales in order to satisfy Spencer's case, which is the backbone of all valuation concepts. Corporate America has already moved and adopted sales as the most reliable and appropriate number to use when forecasting values. However, they use the wrong multipliers. These should also come from market activity, but it is rarely the case. They use very high multiples, we'll call them, which cannot be supported by either markets or sanity. The price you should never pay is the one where you cannot get your money back. Please see my video on Are American Investors Crazy? Anyone who uses risk and returns should now call it invented risks and returns. They are false predictions and you will never get the return or the risk rate they have invented. Sales from trading is the only number that is provable and reliable and the only amount that creates value. All the others are expenses. Why would anyone use lower suspect numbers to create false returns that do not satisfy the law, logic, or reason? The only figure that represents interaction with markets is sales. Sales is the source of goodwill value, according to Muller's case 1901, and there must be a source. Lord McNaughton went on to describe it as the attractive force that brings in custom. Sales also satisfies that definition. The more attractive you make your goods or services, the more sales you will make. Therefore, anyone who uses the lower suspect numbers or those who alter the trading statements via add-backs is committing a criminal offence by declaring they know better than the law and you should rely on their estimates because they believe that anyone who buys the subject business will get the number they specify in perpetuity. He or she ignores the fact that everyone is different. No two people will ever manage the business in the same way. The only number they buy is sales. Clearly, anytime you see a report based on these lower suspect numbers, attack it. It is not worth the paper it is written on. Add back amounts that were claimed as tax deduction for the business, but they are now saying they are personnel and you can add them back, can be added back as profit. These numbers cannot be replicated from other market sales. Cap rates are also misleading by amount or size and duration, and they do not apply to over 90% of businesses, namely lifestyle businesses. We have just showed why trading statements should not be relied on. Now, we will move to balance sheets. This is where accounting concepts move further away from markets, but according to the other side, it is a true picture of value of a business position at time of finalising the accounts or the date shown. Let's go through it. Accounts receivable may never materialise. Look for bad debts or false invoices. Inventory may not exist. What is written down as stock may or may not be there. Land and buildings are shown at historic value or price paid. Only valuers will comprehend this number. Plant and equipment or written down values have absolutely no bearing on market values, full stop. All tangible assets must be accounted for. You should not accept any financial information without checking it, and never believe the liability side of the balance sheet. It may all be contrived. There is never enough information in balance sheets or notes to accounts to make informed decisions. Depreciation is a taxation concept, and its effect on value can be dramatic. Depreciation schedules are rarely complete. In other words, all items do not appear, and the reasons many may be expensed or written off in the first year. Rapid depreciation via government economic strategies, ownership issues, items missing, given away, computers, monitors or TVs are all used for personal use, etc. My aim is to show you or cast doubt on the figures in financial statements, and the only way to know the true current position is to investigate current market values and apply them to the assets being valued. And you should never stop gathering market information until you are confident the result can't move much either way. Do not sit at a desk and try and produce values. Market values versus in situ values, or values within a business. This is not a debate at law on what constitutes a property improvement versus a trade fixture. This is about recording all tangible assets owned by the business at going concern values and the reason behind the increase, if any. There is massive confusion as to what value should apply to tangible assets. Market values should apply to all assets that do not have additional inputs to gain operational status. The only increase to tangible assets is the trade cost to make operational, such as plumbing, electrical, signage, security, and other electronic operations or procedures, such as software specific to the business, not generic. Anyone who relies solely on financial statements then twists, distorts, or uses add-backs moves further away from market activity. The gap becomes even wider, and the contents of their report becomes less reliable. My advice to solicitors is always attack any report on the numbers used and the methods that are used. Make sure they have fully inspected every asset and listed, detailed and applied values based on each asset's attributes, and applied current market values based on substantial research. If these are lacking, attack the author of the report. The accounting world does not share a broad-based view of what constitutes goodwill or intangible asset values, and there appears to be no university training within the accounting courses worldwide. This poses a serious lack of knowledge and questionability of accounting concepts to deal with rapid emerging markets such as internet-based industries. The current methodologies are way off and need immediate rectification to comply with the legal requirements of the High Court decision in Placidome 2018. There must be reliability and accurate measurement. This concludes today's presentation. I hope you get your copy of my book. Thanks for watching.